So the stock market is crashing. Tariffs are crazy. Looks like we might be headed for a recession, and our president is fighting with the Fed. Help us make some sense of this, Sam.
Well, first off, what I attempt to do is to try to stop investors from allowing their emotions to be their portfolio's worst enemy. I always like to say that the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." Will this cause us to fall into recession? Because that is what investors worry about. Bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. We have had 13 recessions since World War II. The S&P 500 has fallen an average of 28% during these recessionary periods. And basically there's no place to hide, whether you look at the S&P 500, the NASDAQ, the Russell 2000 of small cap stocks, or the MSCI EFA, the International Developed Markets benchmark. They have all posted declines in excess of that 28% for the S&P 500. I think that a lot of times people just have too much information at their disposal, and as a result, they become frozen by indecision. I mean, in some ways, I feel that way, and I feel that because of my indecision, my favorite color should be plaid. So also, people are emotional, and so they say, if I buy something, I want it to go up right away. If I sell it, I want it to go down right away. But most people today are so impatient, they get upset if they miss a slot in a revolving door. So you have to understand yourself. What was it? This Old House on PBS, they would say, measure twice, cut once. And so my suggestion to investors is look inwardly first.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. I'm Bill Yount with Jackie Cummins-Koski, who's wearing a special shirt today that we're going to talk about. But we have an awesome guest today who's in the mass media quite a bit. And I've learned a little bit about him researching for this show. But Jackie is going to be the one that introduces her friend.
Yes, I am so happy to have our next guest. Well, for two reasons. He is like one of the smartest people I know when it comes to the stock market, but also he's a passionate financial literacy advocate, just like us, Bill. Let's get into it. We've asked ourselves a question. So is it time to bail or buy? Are we headed for a recession? Well, our guest is a brilliant expert, like I mentioned, on the stock market, and he's going to help us answer these questions. Plus, we'll give you some of his really bad humor to take the edge off a little bit, because we're all on edge right now. So Sam Stovall, CFP, is Chief Investment Strategist at the Center for Financial Research and Analysis, better known as CFRA. This is an independent equity research firm. So in this role, he focuses on market history and valuations, as well as industry momentum strategies. He also makes regular appearances on CNBC, Bloomberg, Fox Business, and other major news outlets. Prior to joining CFRA, Sam was Managing Director and Chief Investment Strategist at S&P Global for more than 27 years. Guys, he's been around. He knows his stuff. He's also served as Editor-in-Chief at Angus Research in New York City. So he is the author of these two books, The 7 Rules of Wall Street, which is right behind me. I have my signed copy, Sam, and Standard & Poor's Sector Investing. Sam's volunteer work focuses on financial literacy, and he shares our passion for teaching others. He's a board member emeritus of WISE, which stands for Working in Support of Education. This is an educational nonprofit that aims to improve the lives of young people through programs that develop financial literacy and readiness for college and careers. Sam Stovall, welcome to Catching Up to FI.
Hey, Jackie. Good to talk to you again. Nice to meet you, Bill.
Yeah, it's nice to meet you too. We're all here about late starters, and we want to get your thoughts on that too, because as you may not know, for me, As an emergency physician, I was a paycheck to paycheck guy that got a late start at around age 50. So I had to catch up to all the information that you knew all your life. And I've been a practicing independent DIY investor for the last 7, 8, 9 years. So I'm very interested in what you have to say about market history, because my market history is a little bit short-sighted, being only involved in it the last 9 years.
Yeah, I think I might have been into the market before you did, Bill, or at least started waking up. But before we get into that, Sam, tell us a little bit more about your passion for financial literacy and your involvement in WISE, because I think that's an amazing organization.
Well, I went to Muhlenberg College in Allentown, Pennsylvania, and I graduated with a degree in history and education. So I was certified to teach social studies on the secondary level. My other passions were I was going to coach football and grow a potbelly, and the only thing I can say I've accomplished is that I've grown that potbelly. Knowing that I enjoy teaching and sharing my knowledge with others, I actually feel like that's what I do at my job at CFRA, what I did when I was at Standard & Poor's, and what I do outside of my business career, and that is working with WISE, working with the students at Muhlenberg College, where I'm on the board of trustees. So really just trying to share because people were so kind to me when I was growing up.
Do you work with just mainly one school, which I know about Cardinal Spellman? We're in the shirt, shout out to Mr. Schoenberg and his students. But do you work with other high schools in the New York area? Like, how are you doing that these days?
Well, these days I'm not really. It's just Cardinal Spellman that I'm doing. Prior to COVID, however, sure, I spoke to the High School for Business and Finance in Lower Manhattan, spoke to Aviation High School in Queens, and even would go around the country and visit with friends who were teachers at those different schools. And then I would come in and do some financial literacy volunteering, answering questions, etc. I've had the opportunity to join WISE whenever they go to the floor of the New York Stock Exchange, ringing the bell to award the students that score quite highly on the WISE exam.
Well, I love it. And you're just a man after my own heart, meeting with these teachers, coming into classrooms. We need more of that because you have such a deep knowledge, and for you to be able to give back at such an early age makes a huge difference. So thank you for doing that. We will definitely drop a link in the show notes. And again, that is WISE. It's got an exclamation where the I is. But if you want to support that organization, we'll definitely share that information for you. So now back to the topic on hand. It's been a very tense year, right, to say the least. So the stock market is crashing. Tariffs are crazy. Looks like we might be headed for a recession, and our president is fighting with the Fed. Help us make some sense of this, Sam.
Well, first off, what I attempt to do is to try to stop investors from allowing their emotions to be their portfolio's worst enemy. I always like to say that the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So what I try to do is to teach investors to say, look, the reason that you are investing, usually it's for retirement, but it's really deferred consumption. You want to make sure that the money you're putting away today that you would have used to buy food, beverage, whatever, will grow with inflation and beyond to therefore outpace both inflation and taxes so that you can afford that when you do go into retirement. The best way of doing that is by owning equities, either by owning stocks individually or owning them through mutual funds or ETFs. What I try to do is really calm investors' nerves by teaching them about stock market history. The S&P 500 fell around 19% from February 19th through April 8th. And amazingly, people thought the world was coming to an end. But interestingly, the average decline in a recession-induced bear market has been more like 34%. And bear markets without recessions have declined an average of 28%. So in a sense, we got off fairly easy if we believe that the bottom has already been put in place, which I think is a good likelihood. And the reason that I say that is because I monitor indicators that show bullishness as well as bearishness. They were all trading at extreme bearish levels. And as Baron Rothschild once said, the best time to buy is when there's blood in the streets.
Oh my goodness, blood in the streets. I refer to this market as a yo-yo market. It seems like we're taught that politics and parties shouldn't really influence the market maybe in the long term. But in the short term, it depends a little bit on what our administration says about whatever it is, tariffs or the Fed, and we watch it just bounce up and down. I've never seen that before. Have you?
Well, history says that we have had situations like that. Back in 1993, we had what was called Hillary-gate at the time, which was the new Clinton administration looking to make some major changes with healthcare, and that threw that sector into a tailspin, pharmaceuticals in particular. In 1961, you had a battle between President Kennedy and U.S. Steel, which triggered a 28% bear market because U.S. Steel wanted to raise the price because it felt that we were coming out of recession and that they could get the higher prices. Well, President Kennedy didn't want anything to do with that and started a spat, if you will, between himself and U.S. Steel. Wall Street did not like the fact that the president was trying to dictate what businesses should do. So in some ways, you could say it's a little bit similar with President Trump looking to coerce Fed Chair Powell into cutting interest rates, as well as taking a very draconian approach to adjusting trade policy with our trading partners around the globe.
That comes back to tariffs. And I've never been through tariffs. It was back in the 1930s where it was, Smoot-Smalley or something like that, where there was a policy that caused similar disruption and made the Depression worse. So that to me is the only historical point that I have to stand on. I'm just not sure what to expect. Can you expect anything from this? Like I said, to me, it's a yo-yo.
You're absolutely right, Bill. Yeah, it is a yo-yo primarily because what is said on one day is walked back on the next day, either by the one who said it originally or by one of his team members. So what happens is investors are saying, well, what am I supposed to be doing? If there's uncertainty, then that is what investors don't like at all. Sure, there's uncertainty as to how much a company is going to earn, et cetera. But when policies are being adjusted that stop companies from being able to make plans for how they're going to operate within these confinements, then that ends up being a problem. So I think when companies are going to be reporting their profits for the first quarter of this year, what analysts are hoping for is some guidance for the second quarter and for the rest of the year. Unfortunately, they're probably not going to get it, or management will sound like two-handed economists, meaning on the one hand this, but on the other hand that. So if the tariffs continue to be that yo-yo, then I don't think they're going to offer much guidance at all. So we need more clarity from a trade perspective.
Correct me if I'm wrong, Sam, but I think Bill meant Smoot-Hawley. Like, Bill, didn't you watch Ferris Bueller's Day Off? Come on.
I did the best I could.
Did I get it right, Sam? Smoot-Hawley, and that's all about trades and tariffs and stuff?
Yes, the Smoot-Hawley tariff of 1930 basically felt that because the economy was slipping into recession, not just in the U.S., but globally, the thought was we're going to focus on ourselves, in a sense, become insular, put up trading barriers so that we can purchase our own goods, etc. But what they did not really know, and most economists had told them that was the wrong thing to do, was that it would end up causing other countries to raise their barriers. Back then, the U.S. probably traded a lot less with overseas partners than they do today. Right now, the estimate is that about 40 to 45% of the revenues for companies in the S&P 500 come from overseas operations. And there are some industries, like retail in particular, footwear, clothing, apparel, where 90% plus of those items to be sold come from overseas. So what you're really doing is, in a sense, signing the death knell for many of these small and medium-sized companies.
Well, it seems like we're practicing isolationism in a globalized economy and trying to turn back the clock. Is that a correct assumption?
Yes, it is. And a lot of people, especially if they're political and they're trying to make a point with their constituency, is to say we shouldn't be offshoring any of our manufacturing or our operations. But actually, that's what England did back in the 1700s. It offshored its manufacturing to New England, the colonies. Then when it became too expensive to do in New England, it offshored that manufacturing to the Carolinas. When the Carolinas became too expensive, then that was offshored to Mexico. So essentially, low or no skilled labor seeks out the lowest common denominator or the lowest cost. And so that's why many of these operations were sent overseas, because the cost per hour is $6 in some countries versus $46 per hour here in the US. So there is quite a difference, and that's why businesses made those decisions.
So, Sam, I'm going to ask you to get out your crystal ball. So, for tariffs, okay, how do you think this is going to shake out? Like, you have a little bit more knowledge, history, and decades of researching and understanding this stuff. How do you think this ends?
Well, I'm going to cheat and parrot what CFRA's Washington Analysis Group, which is a political strategy arm of CFRA, and what they have concluded is we'll probably end up not having 245%, 145%, or less tariffs in China, probably down to about 10% for a majority of our trading partners, to bring everything down to a more equal, level playing field. And so I think that there will be some tariffs, but it'll probably be closer to that 10% level that was initially mentioned, and certainly not the 100% plus that we currently have on China.
Okay, but you believe it's mainly this uncertainty right now. One thing one day, another thing the next day. Ooh, I didn't mean to say that, or whatever. You think that's the main reason for this, like Bill was saying, this yo-yo market that people are not sure what to do, and it's up 5% one day, and the next day it's up 4%, just all over the place.
Now, I think the uncertainty is leading to the next question, which is, will this cause us to fall into recession? Because that is what investors worry about. Bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. We have had 13 recessions since World War II. The S&P 500 has fallen an average of 28% during these recessionary periods. And basically, there's no place to hide. Whether you look at the S&P 500, the NASDAQ, the Russell 2000 of small cap stocks, or the MSCI EFA, the International Developed Markets benchmark, they have all posted declines in excess of that 28% for the S&P 500. And when you look at the sectors within the S&P 500 since 1990, whenever you have had declines of 10% or more, there has been no place to hide either. All sectors have posted average declines. Of course, the cynics would say when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. So food, beverage, tobacco, and healthcare end up falling less than your more cyclical sectors like industrials, financials, and technology.
Wow. So just to have a very clear definition of a recession, what is the technical definition?
Well, a rule of thumb is 2 successive quarters of GDP decline. That was a rule of thumb generated by an economist named Arthur Okun, or Okun, however you pronounce it. He was an economic advisor to Presidents Kennedy and Johnson. And that works about 99% of the time. It did not work during one of the recessions in the early 1980s. The official arbiter of recessions, however, is the Business Cycle Dating Committee found within the National Bureau of Economic Research, NBER. So you can find information there, nber.gov, and there you can see what they look at. But it's primarily industrial production, which is the output of all factories, mines, and utilities. They look to retail sales. The consumer represents 70% of the U.S. economy. It looks to GDP. It looks to environment as well as employment. And they look at all of those different factors, and then they tell us, usually about 6 months after we have fallen into recession, oh, the speed bump we hit 6 months ago, well, that was the beginning of a recession. But the interesting thing is that the stock market anticipates the start of recession by about 6 months. So if that holds true this time around, then maybe we end up falling into a recession in August of this year, and recessions tend to last about 10 months on average.
I think a lot of times when people are talking about how bad the stock market's doing or how volatile it is or whatever, they're almost immediately talking about a recession, but you're making it clear that a recession is maybe the market might be one indicator, but you've got so many other economic indicators that you use as a measurement to say whether or not we're in a recession or the likelihood of heading to a recession.
Exactly. And also, when we fall into recession, then yeah, we typically are looking at a bear market, as I mentioned, with the average decline being close to 30%. But we've only had 14 bear markets since World War II. We have had 25 corrections, which are declines of 10 to 20% that then turn around and get back to break even. And we've had 65 pullbacks or declines of 5 to 10%, then get back to break even before going even lower. The funny thing is that the Nobel laureate economist Paul Samuelson once said, the stock market has anticipated 9 of the last 5 recessions. So basically, I like to say that investors are no better than hyperactive first graders playing musical chairs, always trying to out anticipate the other as to when the music will start or stop. So if Wall Street starts to get nervous, then it's like, oh my gosh, we're going to end up in some sort of a correction or a bear market because of a recession. And then you find out, false alarm, it was just a hiccup, something that we worried about, but really was not the case. And what's amazing then is the speed with which the market gets back to break even. In those 65 pullbacks that we've had since World War II, the market has taken only 1.5 months on average to recoup everything that it lost in that 5 to 10% decline. Better yet, if you look at all of the declines from 10 to as much as 19.9%, we've gotten back to break even in an average of only 4 months. So more than 85% of all declines of up to 20% got back to break even in an average of only 4 months. So as you had asked me early on, Jackie, the answer is because of that, you are better off buying than you are bailing.
Right, right. So you're right with that. So I guess right now, I'm thinking about like more recent history. We're emotional creatures. We talk a lot about how you feel and we want to validate that your feelings make sense and it's normal. But are there any recent pullbacks? I don't know if I should call it a recession, but are there any recent market drops that have been this volatile, this wild that you can point us to?
Well, 2020 was a good example because we really had nothing to compare it with. The current one, we're comparing it to the Smoot-Hawley tariff of 1930. Well, the pandemic, the COVID pandemic, we have to go back to 1920. So instead of 1930 with Smoot-Hawley, it's 1920 with the Spanish influenza. But in 2020, we had the pandemic. The S&P was down 33%. Yet it took us only 5 months to recover everything we lost in that 33% decline that occurred in about a month and a half. So we exhibited the glide path of a crowbar from February into March of 2020 and then climbed right out of it 5 months later and we're back to the races. So I would say, yeah, we've had a fairly recent example of incredibly high volatility, a very steep decline that then it was a V-shaped sell down and then recovery. Normally, you say that the bull market takes the stairs, but the bear market takes the elevator because I believe fear is a much greater motivator than greed. And I say that because going back to World War II, if you look at the volatility during declines of 20% or more, 44% of all trading days have seen 1% volatility or more. Yet during bull market periods, the average is only 15%. So 15% of trading days during bull markets experience volatility of 1% or more, yet 44% during bear markets.
I mean, we've had so many dips recently, and people talk about buying the dip. But to me, buying the dip means you've had cash on the sidelines that should be invested already, and it's almost like timing the market. How do you feel about buying the dip?
Well, it's frequently people will be asking, what do I do? What do I do? And you can say that you can buy the dip by rebalancing your portfolio, because if your portfolio has cash or has bonds in it, then the percentage of the cash and the bonds in that portfolio has risen as the percentage of equities has declined in price. So, in a sense, you can, by saying, I'm going to rebalance, go back to the allocation that my advisor and myself had decided upon based on my time horizon, risk tolerance. Then you can say, okay, well, then I am buying this dip. Or if you do have cash on the sidelines, some people feel comfortable having dry powder, 5% of their portfolio, 10%, or maybe even a little bit more, because maybe they don't reinvest their dividends. They let the dividends accumulate, so they have this dry powder with which to make investments during times of decline. Yes, I agree that you end up, in a sense, timing the market by saying, well, if I buy the dip, well, I have to know when to buy the dip. The average pullback is 7%. The average correction is 14%. The average bear market during recessions is 28%. So you could almost call that the 7% solution, that at every 7% decline threshold is when you have to put some more money to work. And so there are a variety of things that investors can do to make themselves feel as if they're doing something. Whereas another good suggestion is don't do anything. There's a time to buy, there's a time to sell, and there's a time to go fishing. And usually when the market is tanking, that's a good time to go fishing.
Yeah, I mean, you talk about rebalancing, and typically I've rebalanced in January, but I seem to get burned by rebalancing at more of a high. And you have some historical information on seasonal investing that I'm interested in. Is there a better time typically to rebalance, or is it just pick a day and do it?
Well, seasonally, yes. What we find is that there's an old saying of sell in May and go away, because from April 30th through October 31st, the S&P since World War II has gained an average of less than 2%. Yet from November 1st through April 30th, the S&P has gained an average of close to 7%. And so, 7% versus 2%, you could say, well, then that's a good reason to maybe look to be buying back into the market at the end of September or into October. September is by far the worst month of the year, posting not only the lowest return, but also the market has fallen more frequently in September than any other month of the year. Now, some people might be worried about buying into October because October has experienced 35% more volatility than the other 11 months on average. So it depends on how brave you are, but history would tell you that no, you probably want to be buying in the end of September, because also, especially during midterm election years, which would be 2026, the second and third quarters traditionally have declined because of the uncertainty leading up to the midterm elections. Yet, interestingly, from October 31 of midterm election years until October 31 of the year after, the market has never declined, and it has posted an average advance of about 15% or so.
So instead of Bill rebalancing in January, do you think that's a good idea, or there might be a better month he might want to do it once a year?
Well, could be the end of September, because usually that period is weak. Actually, if you look to a publication called the Stock Traders Almanac, typically September ends up looking like a square root sign, where you come in, it drops, and then heads higher before closing out. So usually around mid-October is possibly the best time to be adding to your equity portfolio.
All right, Bill, there you go.
Well, maybe I'll change. But this is, again, sort of a market timing discussion. And this is based on statistical analysis, which some people poo-poo a little bit and just say, just keep buying, don't pay attention to anything. And statistical analysis, looking at trends and whatnot, can throw you off. Is that true?
Yes, I think that a lot of times people just have too much information at their disposal, and as a result, they become frozen by indecision. I mean, in some ways, I feel that way, and I feel that because of my indecision, my favorite color should be plaid. So Also, people are emotional, and so they say, if I buy something, I want it to go up right away. If I sell it, I want it to go down right away. But most people today are so impatient, they get upset if they miss a slot in a revolving door. So you have to understand yourself. What was it? This Old House on PBS, they would say, measure twice, cut once. And so my suggestion to investors is look inwardly first. Find out what kind of an investor you are. Do you want to do the driving or do you want somebody else to do the driving? If you are emotional, then embrace a rules-based investment approach and have that approach basically tell you, don't think, just do what I tell you.
That's pretty cool. And I think a lot of us do kind of get ourselves in trouble trying to time the market. And the best advice we've been given by many professionals is pick the strategy that works for you, but the key is to stick with it. You can't be hopping, like you said, the plaid thing, you're all over the place. You had mentioned something that I had started doing many, many years ago. We also know each other through Better Investing, and you've done a lot of talks there, but I don't reinvest my dividends. I don't have them automatically reinvested, but when they pay out, they sit in my account. So when there's opportunities like this, that is when I deploy that cash. So I don't take it out of the account. I just don't want it automatically reinvested back into the index fund or the stock or whatever. And that did make me feel good, like I was doing something, because I don't have gobs of money, but when I have a few crumbs that's been dropping from these dividends, then I'll reinvest them when I feel like it's a good time. So thank you for validating.
Well, you're talking about a taxable account. Let's be clear here too, because I automatically have things reinvested in my tax protected accounts because I don't need the cash there to redeploy. In a taxable account, it also keeps you from wash sale rules if you end up wanting to tax loss harvest if you're reinvested.
That's a good point, Bill, that in an after-tax account, if you decide to sell something because it's down and then you get a dividend after you sold it, then there is, for that portion of the dividend, it gets taken out of the being able to write it off your taxes. But you can still benefit. It's a personal decision. But whether it's a tax deferred or a taxable account, by having dividends go into a money market, you can then choose when to deploy that cash. But that is your decision as an investor, because you might say, well, I don't know when to deploy it. I'm not a good market timer, so I'm not going to try to time it. I'll let the market time for me, and in a sense, dollar cost averaging by reinvesting those dividends.
Yeah, and when you have the dividends just come out, even at a taxable account, you not only can determine like when you want to get it back in, but what you want to put it back in. You may not want it back into the same index fund or the same stock or whatever. But again, back to the whole point, pick your strategy, stick with it, and stay the course. And that is so much easier said than done. But I think the more we normalize and talk about these things, that there isn't anything you have to do, because these swings are so quick. Who can catch them?
I don't reinvest my dividends in a taxable account, but I make sure at the end of the month or when they come due, quarterly or monthly, I go back in and invest them. I don't want to let cash drag.
Right.
Do we have questions about the Federal Reserve? Give us a definition of the Federal Reserve, because we've been hearing about it more than we ever have before.
Well, the Federal Reserve was started in 1912. The act was approved, and then the Federal Reserve was populated in 1914. The result, or the reason that we came up with the Federal Reserve, was the financial panic of 1907, 1908. And basically, J.P. Morgan brought all of the other bankers into a room, locked the door, and said, "You're not leaving until we come up with a solution." And the solution was that they put money into the market to stabilize. But at the same time, the government concluded we need to have a central bank. And that was when the Fed was created. It has two mandates: employment and inflation, keeping inflation down, keeping employment up, which is sort of hard to juggle both. But that's what the Fed tries to do. And it's always very easy to be a Monday morning quarterback to say that the Fed has not done a good job, because they have to take their time to make sure that they are not playing whack-a-mole and making changes too quickly.
Well, our current president wants to see interest rates come down. Is that to try and offset the effect of tariffs dropping the market?
Yes, I believe it would be to also defray the possibility of recession and just to get the consumers more willing to go out and spend.
Sam, you've been very helpful to us talking about current market conditions and history. We really appreciate your insights and the crystal ball that you bring to bear that the rest of us find pretty cloudy. I want to thank you on behalf of Jackie and myself for joining us today on Catching Up to FI. We hope to see you again in the future to talk again about current market conditions.
I look forward to it, Bill. Nice to meet you. Jackie, always a pleasure to see you.
All right. You have a great rest of your day. We'll see you next time on Catching Up to FI.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to FI. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to FI. Cheers.